When comes the Powell pivot? Welcome to the Real Vision Daily Briefing. It is Thursday, November 10th, 2022. I am Weston Nakamura, Real Vision's global markets editor based in Tokyo, and I'm joined today with a very special guest, Mr. Michael Howell. He's the CEO and founder of CrossBorder Capital. But before we get started, we also have Andreas Steno Larsen, who I have interrupted in his vacation in paradise to just walk us through CPI and the market price action. So, Andreas, you look slightly warmer than you are usually when I talk to you, but thanks for joining us. How are you, man?
I'm good, thank you. It's a bit warmer than usual for me down here at Cayman, but I'm enjoying it anyway.
I would hope so. So look, we had CPI come out today, and looks like both on headline, not that anyone really cares about headline anymore, but and as core as well, has basically come in below consensus, and we see a massive cross asset move. And so, can you just walk us through both of those? Maybe let's go through the CPI sort of figures themselves. Is there anything that popped out at you, and anything that we can kind of extrapolate from in terms of monetary policy out of the U.S.?
What a rally we have across right about everything today. And I guess the trigger is this CPI report, obviously. If we look at the details, I've been saying for quite a while that we should expect the prices of goods, so physical goods, to either disinflate or outright drop in the coming quarter or two. And I think if we look a bit beneath the surface of this core CPI print at 6.3%, that the goods component is the exact reason why we have a surprise to the downside of expectations for inflation. The monthly number is around 0.27, so month-on-month growth below 0.3% in the core inflation number. We haven't had such a low number since summer of 2021. So I guess this is a biggie for the momentum of inflation overall, and I think that's why we have this material response in markets. But let's look at the details. I mean, I've been saying that the price of goods needed to drop as a consequence of a reopening of supply chains globally. We have clearly lower freight rates from China to the West now. That's good news for the price of goods in a negative sense. We have demand destruction ongoing a lot of places around the globe. PMI is below 50 right about everywhere you look. So I think this is a natural consequence of an economic slowdown globally that we see this reaction in goods prices. But if we look at the price of services, the trend is actually still intact. The most important component of service inflation is the rent of shelter cost. It's up around 0.6% on the month, basically the same kind of trend that we've seen in the shelter cost over the past couple of quarters here, which essentially means that service inflation is still moving up on a trend basis while goods inflation is moving in the other direction. So we have this theme of goods disinflation or deflation versus service inflation. And I think when we sort of boil the two trends together, that when the dust settles into next year, a new natural level for inflation is probably above 4%. That's at least what my models tell me. And I think in the light of a stabilized level of inflation of above 4%, the Fed's got a lot of work to do still, and we obviously got a lot of Fed members at the wires already.
Yes, indeed. Yeah, just to put some context in that, even before the CPI print came out, we had two Fed speakers who were saying, yes, they weren't obviously being dovish by any means, but they were being cognizant of doing too much or being aware of potentially breaking something. But however, we have a job to do, and that is to get inflation down. So I suppose that more rate hikes to just keep coming as of now, and then it'll just be how long they stay up is sort of the takeaway from this one reading, right? And is there anything that we can really take from this one reading, or because one reading is certainly not enough, right?
Yeah, sure. I mean, let's take a step back and look at what Powell has actually told us in the past months. I think he's been clear that he's afraid of repeating the mistakes made, in particular in 1974 and 1975. What the Fed did in 1974 was that they made a very swift pivot as inflation turned lower. And the ultimate issue was that they made too swift a pivot to ensure that inflation actually stayed in a disinflationary trend. And ultimately, we got a double top in inflation during that period. It was obviously not only the Fed's fault, but the Fed was part of the problem in hindsight. And therefore, Powell has kept reiterating, we will keep at it. A direct referral to Volker's book, Keeping at It, basically meaning that interest rates will have to remain higher for longer to ensure that the animal spirits will not resurface as soon as we see these disinflationary trends that we do now. Because I think it's fair to say that the peak is in. I think we will have more downside in inflation in the next quarter or two. But I think the level that we should expect it to stabilize around is above 4% or maybe even closer to 5%, at least if you look at the underlying fundamentals of various price surveys, etc. So the point here is that if these animal spirits resurface, as we see today, Nasdaq running at 7% gains on the day, we see renewed gains in crypto space less than 24 hours after the biggest blow up in the sector ever. I personally think it's a crystal clear signal to the Fed that they will have to once again reiterate that if we don't listen to them, then we risk ending up in a double top inflation scenario, and therefore they will have to keep going until we get the message.
Listen to us, do not fight us, essentially, right? Yeah. Thanks so much, Andreas. And then just real quick on, as you said, Nasdaq, plus 7%. That is obviously a massive move, but let's also keep in context, as I said yesterday on the Real Daily Briefing, when crypto was blowing up and crypto was moving the Nasdaq over the last 2 days prior to that. We have to keep that in mind as well. A lot of that downside of the last 2 days was not derived out of equity indices, but rather out of the crypto space. So when you see a 7%, single day move, that is, first of all, that's a lot of that is short covering. Yes, there's going to be some new longs in there, but it's also basically kind of getting back into equity markets and moving on their own merit rather than another asset class like crypto as well. So all of that stuff to keep in context. Andreas, go keep working on your tan or whatever it is that you're doing. Thank you for joining us and for your insights as always, and enjoy yourself.
My pleasure.
So, Mr. Howell, let me just first ask you because this is a pretty sizable move intraday. I know that you're not very, you're not like an intraday trader or anything like that. But any takeaways from either the CPI print in of itself and or the market response or the possible policy implications?
Well, I think the market response is understandable because everybody has been spooked by inflation. But I think you just got to listen to what Andreas just said. Inflation is coming down. There's no question about that. I would suspect that by the middle of next year, it'll be far, far lesser a problem than people originally anticipated. But the reality is that the market has probably overreacted to this. The Federal Reserve still means business. The adage that you've got to listen to again and again is don't fight the Fed. Don't fight the Fed. Don't fight the People's Bank of China. Don't fight the BOJ. Don't fight the ECB. Central banks mean business. They are in charge again in a way that they haven't been for decades. And that's what we've got to pay attention to.
Yes, indeed. And speaking of which, let's talk about cross-border capital and sort of your process and your approach. So I've been following you for some time, but I'm going to completely butcher explaining your sort of approach and how you analyze markets and sort of global market behavior and capital flows. So if you want to just give kind of like that, like an overview or a real quick overview for the audience as to how you approach markets and analyze them.
Sure, with pleasure, Weston. Quite simply, money moves markets. It's not money in the real economy that moves financial asset prices. It's money in financial markets. What we do is we spend a lot of time monitoring flows in financial markets. That's not M1 or M2, as is sort of the conventional monetary aggregates. Those refer much more to retail money that is in banks, high street banks that drive the real economy. If you want to know what's going to happen to inflation and the real economy, take a look at M2. If you want to know what's going to happen to financial asset prices, don't bother about M2. Start looking at financial liquidity measures, how much money is sloshing around in financial markets, and that really matters. What the Federal Reserve and other central banks are doing right now is pulling vast amounts of money out of financial markets. They're making them pretty illiquid, and they're delivering a massive wealth destruction. As of the end of October, partially the latest rally in markets, but as of the end of October, the central banks had managed to destroy a whopping $29 trillion of wealth so far this year in the world economy. That now beats the wealth destruction in 2008 in the global financial crisis. It represents about 25% of world GDP. These are significant numbers. And the reality is that probably too much liquidity has been squeezed out of financial markets. They've created illiquidity. The problem is they've created a lot of illiquidity in the sovereign debt markets. Rather, unlike 2008 and earlier crises, the fundamental problems are not really in the credit markets this time. There are pockets of problems in real estate or credits, I accept, but it's really in the sovereign markets. And you can see that in a chart that I think you can put up, which is looking at a measure we give of market liquidity, which is based on analyzing the US Treasury market and the US Forex market spreads. What that shows is significant declines in liquidity this year. But for comparison, we compare that with what happened in 2008, and you can see the profile is not dissimilar. But in 2008, there was an upleg as the central banks were forced to come back in. And I think that's the thing that we've got to start thinking of right now. Our view is that there is a pivot coming. That pivot is not because of problems in the real economy. That is likely because of building problems in financial markets. And if you want evidence of that, listen to what Janet Yellen was saying 2 or 3 weeks ago about problems in Treasury market liquidity, or more pointedly, look at the alacrity with which the Bank of England jumped back in, reversed its QT, started to do QE once again to save the sovereign debt market in the UK. This matters for central banks and for treasuries. It's a big, big issue. And whatever one may say about the merits or demerits of inflation rising or falling right now, the big issue out there, the elephant in the room, is the fiscal problems that are emerging on the horizon. And I can go into that by all means if you'd like, but the numbers just do not look good.
Sure. Yeah, let's get into that. But if I can, so just so I understand, I kind of want to break it up into sort of two categories, if you will, of how things can break in the sovereign bond market. So one could be sort of more fundamentally based, where you have essentially, I guess, what would be an orderly sell-off, a rise in bond yields, especially at the long end, due to investors who are selling their U.S. Treasury holdings or whatever it may be, because they feel that they are not being compensated adequately for inflation, and the other one being more of a technical sort of market dysfunction, if you will, because of a lack of liquidity on both trading liquidity, market liquidity, and funding liquidity, as you talk about as well. And the latter being what I would think would happen to the Bank of England and the gilt market, where you have a sudden 100 basis point spike in the long end of the gilt curve, and for which the Bank of England had to step in and cap and perform temporary yield curve control on. But do I have that right? Are those are two separate sort of things that we're talking about, right?
Yeah, I think absolutely right. I think that the first thing to say is that I'm a big advocate of tearing up the textbooks, because I think a lot of the textbooks on economics and finance are just completely wrong.
Don't you have a
one of the
PhD,
things to
if I'm not mistaken?
Sorry?
Don't you have a PhD as well? So you're
I do, yes, but
did you throw that away as well?
that probably that might give me an ability to say that a lot of the stuff is wanting. And the key point is that if you take the U.S. market, 40% of buyers in the market don't really pay attention to risk and return criteria. What they're doing is they're buying for reasons of regulation or prudence, or because they have to match liabilities or duration or whatever it may be. Risk and return don't really come into that equation. And you can see that very clearly with what happened in the UK gilt market. And, many people speak about the, sort of the death of the 60-40 investment model. In other words, holding 60% in stocks and 40% in bonds. The reality was that model died many years ago. And what you were in practice looking at was a model that was in fact started off with 80% in equity and 20% in fixed income. But because of regulation, the 20% in fixed income was leveraged about 5 times, okay, through derivatives. And that's what a lot of pension funds were doing. And what's more, they may have taken 20% out of the 80% equity pot and put that into a liquid assets like private equity. And so when you started to get dislocations in the fixed income markets, particularly in the UK gilt market, the whole thing unraveled very fast, and you got this huge illiquidity hit. And consequently, what was happening was, because you've got margin calls on the derivatives, a lot of these funds were being forced to sell the only liquid assets they had, which bizarrely were government bonds. And so the whole thing basically ballooned out. You got this vicious circle of rising yields, and the Bank of England had to step in. Now, that's partly, market events, but it's also the technicalities of how these things operate. The problem is, the fundamental problem that world financial markets have is there is a structural shortage of safe assets in the system. And basically, a lot of funds have to leverage those. And that's what's causing the problem. I mean, just look. I mean, I've said before on my occasions on Real Vision, it's wonkish to think in these terms, but start looking at the term premium in government bond markets. The textbooks tell you that term premium, which is what you would normally get as a reward as an investor for holding interest rate risk, is now something you've got to pay to the market. You've got to pay to take interest rate risk. So the further out on the curve you go, in other words, moving from 1 year to 10-year treasuries, you basically have to pay a premium to the market to hold longer dated debt. Now that's not in the textbooks. They say that can't happen, but it's happening, and it's been happening for years. And what that's telling us is there's a structural shortage of these instruments in the system, and that is not good. If you've got such big negative numbers in terms of negative term premium, it's telling you there's something very, very badly wrong.
Yeah, indeed. As it relates to what you were just saying, with the gilt market, so we're basically in this environment of where, collateral is becoming increasingly scarce. With that has, these kind of knock-on effects onto the liquidity or illiquidity, and as we've seen, it can just show up anywhere, but in all, where you would not expect them sometimes, in like relatively liquid markets such as treasuries and gilts, is sometimes where they would pop up, and that's where they would be very problematic, because if you have volatility in G5 sovereign government bond markets, that is not good. Like I was saying recently, how when the BOE was stepping into cap the long end of the yield curve, essentially doing temporary yield curve control. When that was happening, a lot of people were saying 30-year gilt yields had a higher, like, 5-day realized volatility than Bitcoin, and it was kind of like a funny thing to say, but that's actually a significant statement, because the reason that people don't own, the reason that pension funds can't own Bitcoin is because it's too volatile. So what happens when that asset that they hold becomes more volatile realized than that of Bitcoin? They're going to have a fire sale on it, essentially.
Exactly. Well, they've got to think about that, but the reality is that governments are never going to rule out pension funds holding government bonds, because they need them. Now, if you start to look through the math of this thing, this is where it becomes actually quite scary, and this is where you have to sit down, because the story doesn't get better. It becomes a lot worse. Now, if you take the example of the UK gilt market, and the sort of disaster budget that ex-Prime Minister Truss tried to put in place. Let's look at the arithmetic behind that. At the time, or just prior to that budget, the UK tax take minus mandatory spending by the government, including defence, covered the UK interest bill on its debt 1.8 times. Okay. After the budget, which has now been reversed, it covered it 1.2 times. So the UK could still pay its interest rate bill. Okay. Now, what's that same number for the US? The answer is right now it's 0.8. If you look at in other words, the US does not cover its interest bill using tax revenues minus mandatory spending plus defense. That's a very worrying statistic. But as I say, it's going to get worse. The Congressional Budget Office predicts that in the next 5 years, that 0.8 ratio goes to 0.6. And it projects that it goes in the following 5 years out to 2032 to about 0.25. All right. So the US has got to start borrowing aggressively just to cover its interest rate bill. The US, dare I say, is one of the cleanest shirts in the laundry. You start looking around at Europe, it gets an awful lot worse. So this is a fiscal problem that is basically generational, and it's worldwide. It's because of aging demographics and the commitment to mandatory spending, and the fact that as working populations shrink because of demographics, the tax take basically falls with it. Now, there's another shoe to drop as well, because if you look at those Congressional Budget Office estimates, they project the average interest rate on the debt that the US is taking up is 2.1%, right? Good luck there, because yields we know are now over 4%, almost pretty much across the curve. So in other words, that interest rate bill is going to double. In other words, those measures I just gave you should be halved. That's a very worrying figure. And therefore, the conclusion has got to be is that to avoid yields going up, in other words, what I just mentioned, those term premia in the bond market becoming positive again, central banks are going to have to come back with QE. And all this talk about continued QT is pie in the sky. It's just not going to happen. It creates illiquidity in financial markets. And what's more, they need central banks to buy more and more of this treasury paper.
Sounds to me like a certain country that I might or might not be currently in, called Japan, for which government debt is astronomical. Debt burden is getting worse. The amount, I think it's about a quarter of budget spent on the just interest expense alone, but you have extremely low borrowing costs, but they cannot raise them. For many reasons, for those fundamental reasons, but also for those sort of BOE like liquidity reasons. Actually, what I was just saying to you before was that what I kind of think about when looking at what happened with the Bank of England and their temporary yield curve control of 2 weeks when they stepped in and did unlimited bid for UK gilts at the long end. That from BOJ's perspective, from Bank of Japan's perspective, who has been doing yield curve control for 6 years, not 2 weeks, I think that they're looking at the UK and what was happening, and it validated or justified yield curve control. They were saying that's happening in the UK. The UK gilt market is blowing up because they didn't have measures in place like we do. We have yield curve control. We're capping the long end of the JGB curve. If not for that, the JGB market would have blown up far greater, far more volatile, and far longer ago. And so thank God we have that. And therefore, this is why we must, at all costs leave this policy in place, because look at what happened. Okay, this is why we must have. So that's kind of my view. I don't know what your take is on that.
100% correct. I think that's absolutely what they're thinking. Japan has thought about this very seriously. Yield curve control, I would say, on most measures, and in the eyes of most international politicians and policy experts, has been a great success. Janet Yellen, we know when she was at the Fed, was a great advocate of yield curve control. Lael Brainard, vice chair of the Fed, is also a big proponent. It's in Japan. It's obviously operating in Eurozone, with spread control. It's happening now in the Bank of England, although they would like to deny that. And it will probably come to the US. It may be called something else like treasury buybacks, increased bill issuance, or whatever it may be, change in regulations. But effectively, it comes to the same thing. Central banks and treasuries are trying to control the yield curve. And, the currency is a casualty of that, maybe, but that's the reality. Japan has thought about this a lot. If you look at the latest Ministry of Finance projections for the Japanese budget, they go through very carefully the arithmetic and they compare Japan's situation with other international countries. And they point out the fact very clearly that actually Japan is by far and away not the worst country in the world in terms of facing dire prospects in the fiscal space. There's many, many other countries that are in far, far worse shape. And that's the point I'm making. The Japan, as it happens, and the US are not the dirtiest shirts in the laundry here. That's what we've got to start remembering. There's a chart that you can put up which shows the excess supply of collateral in the US, which I think I put there, which is the second chart in the pack. But that very clearly shows the fact that you've got a huge amount of coupon issuance. And this is the projections, I should add, are Congressional Budget Office projections of what's coming. So these are semi-official estimates, and you can see what happened during the COVID crisis, where coupon issuance of notes and bonds in the US collapsed. The orange line on that chart is Federal Reserve liquidity injections, and the projections are that the Fed basically, falls away. But I hesitate to agree with that projection. I think the Fed will have to come back. But just look at that blue line, which is indicating the supply of coupon. And that is all about the huge mandatory spending demands that are coming out in all Western economies and Japan over the next 10 years. It's a eye-wateringly frightening number. And therefore, yield curve control has to come back. In other words, that means more liquidity being pumped back into markets.
Right. And so let me get to the pivot part in a minute, but let me just ask, so Jason from Twitter is asking a question for you, Mike. And so basically, I don't know if you have any take on who the next governor of the Bank of Japan will be once Governor Kuroda is out in April, and any implications from, whoever that may be, if you have a view on that. And then a second one, which is probably more up your alley, but where would the floating JGB 10-year yield be in today, in his opinion, in your opinion, essentially?
Without yield curve control.
Yeah, I'm assuming, without yield curve control.
Well, I think the reality in if you look at fixed income markets is that fixed income markets tend to move very closely. They gravitate together. And I would suggest that you'd be looking at yields. I mean, we're talking about yields of circa 25 bips or so in Japan. I would certainly add 100 basis points to that if there was no yield curve control, maybe even more than that. I think the fact is that yield curve control has been very successful, and I would think there would be every attempt not to try and get out of it. Now, I understand that the yen is an issue. And it must be, given the fall that we've had. But the two greatest anomalies in financial markets right now are the volatility in currencies and the volatility in the fixed income markets. Mm-hmm. And those are the factors that people almost seem blind to. There's an awful lot going on here. And our take on this year has really been one which said US policy, one's got to start with US policy in understanding the markets, is basically about getting the Fed balance sheet down and getting the US dollar up. And I think the policy next year, if there is a tacit policy, it's the absolute reverse of that. It's getting the Fed balance sheet up and getting the US dollar down. So Asian currencies may get some respite out of this, but I think there are, potentially other shoes to drop.
Okay, and then so before we run out of time, let me just ask you on this question or this question that I personally had, but just watching you from your explanation video on Real Vision, as well as the last time you were on Real Vision Daily Briefing with Maggie, but you put out a view out there saying that the move in dollar yen on an annualized basis was something like between March and August, it was annualized something like 80%. It was something crazy, right? Right. And you were saying that markets don't do that; governments do that. Can you explain that. Can you explain what your view is?
Yes,
I mean, it's a view, but it's a possible scenario, essentially.
Yes, I think that this is the sort of dog that didn't bark, if you like, Sherlock Holmes stories. And I think the point being is you can always look backwards and you can justify why the yen collapsed because of Japan's yield curve control and whatever else you may throw in. But what you can't explain through that mechanism is the timing, and the timing is really very important. And if you look at basically what happened at the beginning of this year, clearly the big or the material event was Russia's invasion of Ukraine. And at that time, and this may be, sounds overly Machiavellian, but just hear me out here. What happened was the Chinese began intervening quite aggressively in their money markets and pumping liquidity into their money markets, basically 2 days before, the day of, and 2 days after the invasion of Ukraine, as if, one would surmise they knew pretty much what was happening and they wanted to stabilize their markets. Mm-hmm. Throughout the rest of this year, the Chinese have not been able to put any liquidity back into their markets at all. They've been essentially under the cosh because the yuan has been under huge downward pressure. And I would surmise that that has been instrumented by the fall in the yen. The yen collapsed or began to collapse a couple of weeks after the invasion of Ukraine. It gathered momentum between early March and early May. It fell at an annualized rate of 82%. The Korean won followed, and basically the yuan, the Chinese yuan, tried to resist that. The Chinese were very thorough in terms of taking lots of liquidity out of their financial markets during a period when they're normally adding liquidity. They were very aggressive in withdrawing that. Chinese liquidity cracked badly, and the yuan basically stabilized for a while, but they couldn't hold it. And the more that the yen devalued, the more pressure it put on the Chinese currency. Capital outflows began to accelerate, and ultimately, we know the story that the yuan fell. Now, through that period, neither the Japanese Ministry of Finance nor the US Treasury made any comments about the weakness of the yen. Mm-hmm. There were a few mutterings maybe later on, but through the big falls, nobody said a word. There was no mention of currency manipulation. There was no mention of, trying to steal a march by competitiveness or whatever it may be. Whereas 18 months earlier, when the Vietnamese dong had devalued by a far lesser amount, the US Treasury were up in arms about currency manipulation. So I would suggest that on the basis of the dog that didn't bark, there was some manipulation of currency with an attempt to try and get the yuan destabilized. That is, I think, very important because basically it thwarts China's ability to create a rival to the US dollar in the Asian region. That has always been China's goal. I wrote a book about 2 years ago called Capital Wars, where we went through that. And I said that the main plank of China's policy was to stabilize the yuan with the idea of then creating a rival to the US dollar. China's ability to create a rival now has been put back at least a decade. What it may mean is that Chinese policy changes direction. It may move away from domestic growth, and it may be forced into a policy whereby it has to devalue the yuan even more. So I would say that now we've gone through 7, the chances of hitting 10 are probably even greater. And that may put a significant
dollar yuan USD CNY 10.
Yeah. Okay. And that may put a big deflationary hit onto the world economy. And that's the thing that I think we've got to start thinking about in the future. Now, what's the historic evidence of that? Just go back and look at the 1930s. What you've got are a lot of parallels in the 1930s to what's happening now. And among those things are clearly autarkic or more autarkic economies. In other words, free trade has got barriers around it. There's been scrambles for commodities. There's geopolitical events. And there are huge currency devaluations and appreciations. Currency volatility just was all over the place in the 1930s. And that's the world I think we're moving into right now.
Okay, so that's an extremely, extremely interesting view. So let me just ask you this then. Okay, so let's say that is the case, that the yen weakness has been at the direct hands of both the Ministry of Finance in Japan and the United States Treasury working in tandem, and to do so in order to combat the yuan or otherwise working in tandem. How would you therefore explain something like a yen intervention with the Ministry of Finance smacking down dollar yen 5 big figures in 20 minutes. Does that fit within that sort of, kind of coordinated backdoor planning, or?
Well, I think central banks generally don't like currencies or losing control of currencies. And I think if you see very rapid devaluations, they will try and stop that. But generally, they've been more equivocal about the level of their currencies. I think that's fair. And I would suggest that what the Ministry of Finance was trying to do then was to stop halt the risk of a runaway yen dollar exchange rate. They're probably comfortable with holding it where it is now or thereabouts, and they were effectively drawing a line in the sand. They had basically won the day because the Chinese yuan had basically traded through 7.
So essentially, the initial like 15 or so % move up from March, that was coordinated and sort of managed. But then thereafter, the latest sort of, we'll call it 10-15% up, that was maybe doing it, having it happen too much, and so therefore that was allowed. And I would kind of agree with you that it was allowed because of the deafening silence out of the G5 and G20 meeting, as well as from the U.S. Treasury, who were basically saying, yes, we acknowledge that Japan did that and we're fine with it. Which is kind of, to me, is kind of a, not necessarily green light, but like a wink, wink, nod, nod, like, yeah, go ahead, cap, a runaway dollar yen if you need to, within our kind of broader efforts.
Yeah, the US dollar has been weaponized. It's as straightforward as that.
Right. Right. Okay. Look, Michael, I wish we had more time, because I could talk to you about this, but we have to get you back onto Real Vision to discuss this more in depth. But basically, at the end of the day, just to sort of sum things up, first of all, on Real Vision Essential, there's a video from I think it's August 15th or so, where Mike is talking to Ash, and they break down everything about his framework and how cross-border capital works and analyzes markets. It's videos called Everything You Need to Know About Liquidity. I just tweeted about it as well, so make sure you check that out. But at the end of the day, the framework is that the world works, and asset markets and all that are essentially moving and are priced off of or driven by these enormous flows of capital of existing debt that need to be rolled over, and the capacity and ability to do that. And with basically a shortage of collateral and sort of volatility and illiquidity, you're going to have some massive problems coming up, such that you're going to have a potential central bank or a Fed pivot, or a Fed pause, if you will, in their tightening regime that they're currently doing sometime around, was it Q1, Mike? Or next year, Q1, Q2, somewhere around there?
Yeah, my estimate's been by Q1 there'll be a move of more liquidity back into markets, and that increase in liquidity is clearly going to be good for longer duration assets. And as I said before, the thing to watch are cryptocurrencies. That's not investment advice. It's just basically looking at them as a barometer. They're hugely liquidity sensitive. If there is illiquidity, they go down. They cascade down, as we know. If there's more liquidity, they will just trend upwards. So be a trend follower in these markets.
Right. So yeah, if you want to go out onto the risk, all the way out on the risk curve, especially given the last week of the sell-off, if you want to participate in this sort of reversal and an upside in risk, come this pivot that will come as a result of things breaking in illiquidity in treasury markets, going long crypto or sort of zero cash flow NASDAQ stocks would be the play in which to do that. Obviously not trading advice, just the way that things were basically the last time that this sort of setup had occurred. Do I have that more or less correct, Mike?
Completely correct. 100%.
Amazing. Look, thank you so much. I definitely need to get you back on again, and we'll talk more in depth about BOJ, the U.S. Treasury, and currencies, and cross-border, no pun intended, cross-border and cross-asset flows and all that. But to everyone else out there, thank you for your questions. Thank you for watching the Real Vision Daily Briefing. We are off tomorrow for a U.S. holiday, so everyone have a great weekend, and we will see you on Monday.